Hello and welcome to 5-Year Club video number 331. Tonight's video I wanted to give you a kind of broader view of what's going on with the investment markets. In particular, I guess because they've been volatile very recently, they've been scary recently. The S&P 500 futures right now are saying like minus 1.25%, which means that because of Bush's death, today was a stock market holiday, I think. But on December 6th, which is tomorrow, it's very likely that the market is going to drop significantly when it opens, at least according to the futures. So, bummer. But it's not a bummer, because it's kind of like Black Friday for stocks, you know. In fact, they have 1987's crash was like Black Tuesday or something like that. Anyway, I wanted to just back up and look at the bigger picture. And I started with this article. Bonds are pulling portfolios into negative territory, not stocks. Diversification is making it harder than usual to keep up with the S&P 500. The stock market's 3% drop Tuesday provides the latest proof that volatility is back, but the recent gyrations in major stock market indices doesn't tell the full story of what's happening inside client portfolios. While marquee benchmarks like the Dow Jones Industrial Average and the S&P 500 are getting all the attention, it's the normal steady fixed income component that is wreaking the most havoc on portfolio performance. The S&P 500 is still up 2.8% from the start of the year, but the Bloomberg Barclays Aggregate Bond Index is down 1.3%, which will be dragging portfolios below the closely watched S&P. If you're diversified, there's always a piece of portfolio you're going to hate, but right now you're going to be unhappier about being diversified than usual, said Peter Lazaroff, co-chief investment officer at PlanCorp Financial Services. Even amid the increased volatility that has plagued the equity markets for most of the year, large cap growth has been among the best performing categories. According to Morningstar, the average large cap growth fund is up 4.7% this year, followed by a 3% average return for the small cap growth funds. Meanwhile, the corporate bond fund category is down 3%, and long-term government bond funds are down 4.7%. Fixed income is usually viewed as a safe haven for investors, but this year we saw a spike in interest rates, said Todd Rosenbluth, director of mutual fund and ETF research at CFRA. Investors tend to expect fixed income to provide downside protection within a diversified portfolio, Mr. Rosenbluth said. It's a rare year when bonds have underperformed in a volatile market. The last time the Barclays Aggregate finished a year in negative territory was 2013, when it dropped 2%, while the S&P 500 gained 32.4%. Holy crap. What an amazing year for the S&P 500. The impact of the bond market's pullback on diversified portfolios can be measured by the performance of target allocation funds, which typically increase bond allocations to decrease portfolio risk. Target allocation funds with between 50 and 70% equities, which typically suggest more risk, are down an average of 1.87% this year, while allocation funds between 30 and 50% are down 2.6%. So in other words, if you're in one of these target allocation funds that is less aggressive in stocks, you are down more this year than one that is more aggressive in stocks. Most clients do not expect to lose money in bonds, but they forget about the impact of things like interest rates and duration risk, said Case Eichenberger, senior client portfolio manager at CLS Investments. Over rolling one-year periods, bonds are positive 85% of the time, he said, but bonds haven't been as much of a safe haven as you would expect. Not only is the stock market getting all the attention, but the attention is disproportionately focused on declines in stock prices, says Paul Schatz, president of Heritage Capital. Monday was a big up day, and last week the S&P 500 was up 4.5%. In the short term, selling in this market will look foolish. Mr. Schatz is downplaying the bond market's inverted yield curve, which currently has some shorter-term notes yielding more than longer-term notes, which is considered a precursor to a recession. All of a sudden, the world woke up yesterday and saw the yield curve inverted, he said. Recessions are not a point in time. Recessions are a process. The yield curve inverting on one day says absolutely nothing that it didn't say the day before. What do you think? 0 comments. All right, so let's just like back up a second, right? So I'm going to look at the Vanguard Total Market Index, VTI, rather than the S&P. So it starts out, this is the year to date. So it starts out the year at 138.22, and we're currently at 138.33. So we're barely up. Barely up. And we're going to look at the BNDX, which I think is the Vanguard International Bond Index ETF. So it's kind of like all bonds ever. I'm sure there's another one that's just U.S. bonds, but I don't remember what its name is. Anyway, that started the year at 55.20, and we are now at 54.93. So, in fact, over the course, I can't stand this whole like they tell you what the daily movement is. That's so dumb. But we also see that there is a dividend yield here of 2.24%, where the dividend yield from the from VTI was only 1.85%. Dun, dun, dun. What does that mean? What does any of this mean? Well, it means that even though, I guess, in a lot of ways, this year was not a very fun year to invest, right? Because if you invested in this year, generally speaking, I don't know, for me, I invested a lot, like, I don't know, at some of these places. And so, like, I have not, I'm down. The money that I invested this year is down from what I had. And that is no fun. But the money that I had before this year, it hasn't really moved, which I guess is also bad because you want it to meet inflation. But point is, even though the volatility is like scary right now, it's volatility around something that's actually pretty steady. We have big ups, we have big downs. What are we going to do in the long run? I don't know. But yeah. But yeah. If you look at this on like a yearly point of view, not such a big deal. And I think also this says like, look, even if the stock market is volatile, doesn't mean you shouldn't be in it. And it's throwing off those delicious equity dividend nuggets. Nuggets is maybe not the best one. All right. Okay. Vanguard ETFs. Choose your ETFs. All right. Let's go see if we can find a different bond ETF. Blah, blah, blah. Come on. Give me a list of ETFs. Give me a list. So Vanguard Total Bond. Total International Bond. So what I really wanted was BND. And year to date, BND, yeah, 81 down to 78. Not the best. 2.76% dividend yield. Yeah, so rising interest rates. Being that the older, those older, lower interest rate bonds that you're holding, they're not as attractive, and so their value goes down. And so the value of your bond portfolio goes down. Bummer. All right. Well, that is it for video number 331. Hope you enjoyed it. I hope that this shows you why even in a scary, volatile market, stocks still look pretty good. Holding bonds in the long run is no good, guys. Don't do it. You need to be holding equities in the long run. All right, well, that is it. Have a fabulous evening.